Good morning, traders and investors. Today is Wednesday. It's December 28th. Where has 2022 gone? It's about 8:05 in the morning, and the market's going to gear up to open in about an hour and 25 minutes. Now, as you guys can see here, and by the way, I'm using a bigger mic. It's a little more bass here. I want to see how the sound compares to the other one. If you guys have any comments or feedbacks, please let me know. I call this the Big Bertha. Why? It's a big mic and it carries a lot of bass, so it's Big Bertha. Anyways, the things that gets me excited in the morning. Anyways, as I mentioned, the market is gearing up to open about an hour and 25 minutes. The Dow futures are up about 100 points, which I'm not buying for a minute there. Now, in terms of data this week, it is a light week, and remember, it's a very fragmented week. I'm going to tell you guys something that I've been telling people all day, and actually I should have been saying this a lot longer. And I have been saying it in the morning videos. Liquidity really dries up or starts to dry up a week before Christmas and starts moving in the right direction, usually picks back up a week after New Year's. So you have this dead period, like the last couple of weeks of December and the first week of January. And that's kind of where we're at. We're in the dead zone right now. So stocks, news, events, they will all have more volatility because you have less liquidity. So events and things that happen will have more exaggerated moves. And so you have to be very cautious, and you have to be mindful of it. So in other words, let me give you a hypothetical. Let's say you see the Dow Jones up 100 points right now, okay? Well, because there's so little liquidity under normal circumstances, the Dow may only be up 25 points or 30 points. So these moves are very unsustainable. That's one of the reasons why you're seeing the market go up 200 points, 150 points on the Dow, and then come off, and so forth and so forth and so forth. It's just a lack of liquidity, which means there's lack of long-term commitment to the market. Now, today you've got pending home sales, Richmond Fed Manufacturing Index. I'll get into all of that in a minute. Tomorrow you have a jobless claims, and Friday, the 30th, there's just not much except for the PMI. I believe the bond market is really giving us a very good idea of what's going on right now with stocks, because it's moving lower. And as the bond market moves lower, and as you could see here, let me just go ahead bring it a little closer here. As you could see here, it's now trading below the 50-day moving average. We closed our position yesterday. We had a nice 30+% gain, but that's not the point. The point is, and we hit our exit, which was below the moving average. My point is I do believe that bonds may go lower. And if bonds go lower, that's going to put a lot more pressure on the following stocks. That's going to put a lot more pressure on information technology, on consumer discretionary, and on communication services. Now, I hate to say I told you so, but I did. Notice it ain't all green anymore like it was. Matter of fact, if you look at information technology, only 27% of stocks are trading above the 50-day moving average. 44% communication services. Consumer discretionary, 48. Now, interestingly, you still have 52 trading above the 200-day moving average, 35 trading above the 200-day moving average, and 28. So there's a lot of vulnerability. And as you can see here, the vulnerability is mostly with stocks that are hypersensitive towards interest rates. But it doesn't mean that all other stocks are excluded, because the market is one, and it's like an ocean. It drives everything one way or the other with waves. But as you guys could see here, consumer discretionary is just not looking all that good. And if you look at the broad market, you have 60% of stocks in the Dow Jones trading above the 50-day moving average, 54 above 200-day. But if you look at the NASDAQ, look at this, 36%, 43%, 32%, 37%. And the S&P 500, 50%, and exactly 50% are trading at the 200-day moving average, and 54. So this is not a very strong market. And if you continue to see the bond market, which I'm going to put back here, if you're going to continue to see the bond market trading lower, which I believe it will till it comes down, it's going to put more pressure, and it's going to increase interest yield on interest rates, which causes bonds to go lower and puts more pressure on stocks. Now, let me talk a little bit about the pre-market briefing, give you some ideas of what to expect. And remember, today's Wednesday. Wednesday, you get a long and a short trade. And today, I feel extra giving, so I'm going to give you two short trades. So U.S. benchmark indices closed mixed the first day of holiday, shortened last trading week. That right there says low volatility, as higher bond yield pressure puts interest rate sensitive growth stocks to the downside. That's kind of what I was just taking 5 minutes to explain. Tuesday, Tesla. Tesla plunged over 11%, closing at its lowest level in more than 2 years after Reuters reported that the company would run a reduced production schedule at its Shanghai plant in January. That's not good, sparking worries of a drop in demand. And overall, demand from China is down, including basic materials and industrial parts, by about 40%, just so you know. That was the last month's report. U.S. good trade balance preliminary data showed a deficit narrowing by 15%. That's good, $83.35 billion in November, while the S&P case home price index cooled to 8.6% in October, the lowest figure since November of 2020. Today, all eyes are on the U.S. pending home sales, which I think are going to be kind of weak. Economists on average forecast that November pending home sales will stand at negative 0.8% month to month, compared to the previous value of negative 4.6%. I think it's going to be a little lower than 0.8% based on everything I've been seeing and the way interest rates have been moving. Also, investors are going to focus on the U.S. Richmond Manufacturing Index, which was at negative 9% in November. This is an important report. Economists foresee the new figure to be even greater at negative 10%. That's very, very bad, because that's telling us that economy is, in fact, slowing down if there's less demand for manufacturing. Plain and simple. European stocks received negative handover from Wall Street and Asia after, I thought it was hangover, after main indexes closed mixed as investors evaluated Beijing's step towards reopening its COVID-battered economy. I don't think they have a choice at this point. Market participants are now wary of the prospect of a threatening recession and potentially durable periods of low economic growth, which I think is going to happen regardless in Europe, no matter how we look at it. In China, China index closed lower, failing to capitalize on bold steps from China for reopening the economy. Yeah, fool me once, shame on you. Fool me twice, shame on me. Their National Health Commission on Monday announced it would stop requiring inbound travelers to go into quarantine starting January 8th. We'll see how that works out. A faster than expected peak of infection has stoked expectations that a quick economic recovery is on the horizon. Yeah, don't hold your breath. This has been an issue with China for 2.5 years now. Bank of Japan policymakers discuss growing prospects that higher wages could finally eliminate the risk of a return to deflation. Can you imagine negative interest rates again in Japan? That would be so bad. At the December meeting, the Bank of Japan kept its ultra easing policy, but tweaked its bond yield control policy, allowing long-term interest rates to rise more. Now, of the stocks you have to focus on today, keep your eye on Tesla. It's down over 3% on continuing supply from the fallout from the suspended Shanghai output from China. What I just read right here regarding it, where was it? Where is it? There it is. Shanghai plant. So that's why it's down 3%. And Cal-Maine Food, Calm, also has earnings today. That's the only company, the medium-sized company we talk about, that has earnings. So you'll have to watch Cal-Maine very, very carefully. Now, put the call ratio is fairly even. It's at 1. It's not really overbought. It's not really oversold. There's not much happening there. One thing that's really interesting is this. It doesn't quite seem like it because the market seems fairly neutral, but the number of stocks making 20-day breakdowns is now at 192. That's a pretty significant number, especially when you look at the 20-day breakouts, which are at 64. That means there's 4 times as many stocks. Let's see, not 4 times. Excuse me, 3 times. My math is still off. It's only 8:14 here in the morning. Market's not going to open up for another hour and 16 minutes, so we got plenty of time. But there's 3 times as many stocks going to the downside. Now, 192 is not a significant number. I like to see about 450, 500, 600 to the downside before the rout is over. But 192 is a good start, which is telling me that there is a lot of pressure to the downside compared to the upside. 192 is not to be taken lightly. So don't be surprised if you see the Dow doing a U-turn turnaround back to the downside once again. Very, 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 very possible. Now, in terms of sectors to watch, let me go back to our sector watch and show you what's hot and what's not. And you're not going to be surprised by anything you see here. I promise you that. Healthcare, industrial, consumer staples, energy. It's finally moving to the right place. Even utilities is getting higher. The only thing we need to now see is real estate go a little higher and technology move down, and we're golden. And then you've got a little basic material. But remember, and this is something I talked about during my webinar yesterday, industrial has a lot of the defense stocks, the Lockheed Martins, the Northrop Grumman. Those stocks are in a different category than industrial stocks that build bridges, for example, in China. You know what I'm saying? Or Europe. So there's two classes of industrial stocks and two classes of basic materials. Basic materials, a lot less. But industrial, you've got the defense stocks and you've got the regular industrial stocks, and they're not being separated. So this is a little confusing. So if you look at the defense stocks, they're up here. But if you look at the regular industrial non-war defense type of stocks, they're more down here with the basic materials. And that kind of makes sense, but I have to point this out to you. Nonetheless, consumer staples are strong and consumer staples are coming back. I looked at stocks making 90-day breakouts yesterday. Let's see here. Mornings, General Mills was on there. Dr. Pepper was on there. I think Coke or Pepsi was on there. The bottom line is there's a lot of consumer staple stocks that are breaking out right now to the upside. So you got to be very, very careful. As market is still defensive and nothing has changed. And energy was down here. It's now up here and it's coming back up. Speaking of energy, remember today's Wednesday. We got the strongest and the weakest stock. That's what we're going to talk about right now. Strongest stock is Marathon Petroleum, MPC. Energies are now above the 50-day moving average. They're looking a lot better. I really like this stock. And it's not the only one. There's a lot of energy stocks that are doing well right now. But as you can see here, this route here seems to be ending, and it looks like we're going to be coming back higher. So I really, really like the energy sector. And out of all of them, I like several. But I like this one, Marathon, MPC, and VLO, okay? And Valerio is right here, and you can see it's doing exactly the same thing. They all look like they're breaking up to the upside. So I really, really like the energies right now a lot. Now, to the downside, oh boy, Charter Communications, it's been a dog all year, and I think it's going to erase this and come right back down to the 300 level. Give it a little more upside. It hasn't been overbought yet, but this stock is for the dogs. Another stock for the dogs is Caesars Entertainment. I think the stock is going to break lower. And I think right now with consumer spending getting weaker and weaker and interest rates getting higher, Caesars is not going to be seeing a lot of love. And they have a lot of exposure to China too. I think the stock is going to go down to 31. Also, there's this one stock that I absolutely love. I'm just kidding. It's called Dish Network. Yes, remember we made money on this stock? Well, it's coming back up again. And if it hits 15.5 or 15, I would sell it and take it down all the way to $12.45. Overall, don't expect a lot of directional volatility. There's a really good chance the stock market will go up, down. There's a lot of volatility right now, but this volatility is not sustainable because, again, as I said, there's not a lot of institutional traders, and retail traders can only cause so much damage, usually to themselves. So be very, very cautious. Now, folks, if you haven't heard yet, I finally cracked the code on one market pattern that boasts a 100% win rate on exactly 146 stocks. And this was over a 5-year testing period. Oh yeah, it's like that. That, of course, is based on historic returns. There's no way to know how it will do in the future. We don't have a crystal ball, but I'm very excited about it. And I tried breaking it. I could not break it no matter what I did. The name of the pattern is called the shooting star. Yes, the shooting star. And once you spot it on a daily chart, oh boy, all we have to do is enter the position the next day in the opening bell and then exit when the daily close takes out the previous daily high price. It's really that simple. I found this pattern and a few others do extremely well regardless of what the S&P 500 is doing. Matter of fact, one of our programs had 15 winners in a row. I mean, we did pretty good with this thing. And I'm very, very excited about the shooting star. Now, I find this pattern and a few others can do really well regardless of which way the market goes, which is really important because right now markets are all over the place. And don't take my word for it. Really, don't. Click the link below. Get all the juicy details yourself. Don't miss out. It's really, really good stuff. And by the way, it's much easier to find these patterns than before. Much, much easier. Thanks to a trading breakthrough that I'll show you. Follow the link below. Don't miss out. You definitely want to learn more about the shooting star. It's going to be one of the biggest factors and one of the biggest indicators that I'm going to be using in 2023. You don't want to miss out. Follow the link below. And remember, you have a comment, post it in the YouTube channel under the Wealth Press video. That's where you could find all the links. Subscribe to our channel, subscribe to my Telegram group, and you should subscribe to my Telegram group because you can get pictures of Clyde for free. Clyde is my cat, for those that don't know. I'll talk to you guys later. Have a great Wednesday, and I'll see you on the other side. Bye.